Okay, let's unpack this. If you've been anywhere near the crypto world lately, you've undoubtedly felt it, right? That kind of electrifying energy, a palpable shift in momentum, especially around Ethereum. And there's this particular phrase making the rounds that seems to capture it. Alt season.
Yeah, you hear that a lot now.
But what does that really mean? For the market, for the tech underneath it all, and maybe most importantly for you, listening in and trying to navigate this whole dynamic landscape.
Indeed. And that's exactly what we're diving deep into today. We've got some really fascinating, and I'd say in some cases, pretty surprising insights from a recent Bernstein research report.
Okay.
Our mission here really is to cut through the noise, try to bypass the hype, and get you those essential insights. We're looking at how these recent market shifts are actually playing out,
Right.
who stands to benefit most, and what this, increasing momentum in the Ethereum ecosystem really signifies for the broader digital asset world.
And specifically, we're going to explore why analysts are singling out Coinbase. They seem to think it's a primary, maybe the primary beneficiary of this rally.
That's a big part of the report, yeah.
But we won't stop there. We'll also broaden out, look at other key players, some innovative investment avenues that are riding this wave.
Right, like ETFs and other things.
Exactly. And even think about what the long-term implications might be for, traditional finance. So, yeah, get ready to connect some dots you might not have seen before.
Sounds good.
And actually, before we really dive in, just a quick note. If you find these deep dives valuable, if you're getting something out of this, please take a second to subscribe, maybe drop a comment, engage with the video.
Yeah, it genuinely helps us out.
It really does. It helps support the channel, boosts visibility in the algorithm, how that works. And it lets us keep bringing you this kind of, hopefully, quality crypto content.
Absolutely. Okay, let's get into it.
Right. So, section 1, the macro picture. Let's set the stage. We're hearing alt season Ethereum's resurgence. What does an alt rally or alt season actually signify? Is it just like another crypto pump or something more fundamental?
That's a really crucial distinction to make. And what's fascinating here, according to these analysts, is that an alt rally actually points towards something pretty significant, like a maturation of the market.
Okay. Maturation how?
Well, in crypto lingo, as Gautam Chugani from Bernstein puts it, it happens when digital assets other than Bitcoin, the alts, rally.
But other things are going up faster.
Exactly. And this isn't just about prices going up across the board. It suggests a kind of fundamental re-rating of the value proposition of these other protocols.
Okay.
Think about it. Traditionally, Bitcoin-led rallies often suggested, a flight to safety, the foundational asset, like a digital gold rush kind of feel.
The safe haven in crypto.
Right. But when the alts start outperforming Bitcoin, it signals that investors are maybe willing to take on a bit more risk. They're exploring the specific technologies, they're betting on the wider ecosystem beyond just the pioneer crypto.
So it's like moving from investing in, say, just gold to investing in specific mining companies or tech companies using gold.
That's a pretty good analogy, yeah. It shows the market evolving. Capital isn't just concentrating in Bitcoin, it's flowing into diverse digital assets, suggesting a deeper understanding, maybe a greater appreciation for the different utilities, the different use cases within the crypto space.
Okay, so less about just crypto as one thing and more about the specific projects.
Precisely. It's a signal the market is deepening, recognizing value in the specific innovations offered by various altcoins, especially in this case, those built on robust platforms like Ethereum.
That's a powerful distinction then. Not just growth, but a shift in the type of growth, the underlying confidence. It sounds like a qualitative change.
I think that's a good way to put it, yeah, a qualitative shift.
And speaking of significant shifts, Ethereum has really been leading the charge here, hasn't it? Acting as a major catalyst for this whole alt season narrative. The numbers are pretty astounding.
They absolutely are. I mean, Ethereum's performance has been nothing short of explosive lately.
Explosive is right.
ETH, the native crypto of the network, has gained, get this, 80%, 80, since June 5th.
80% in just a couple of months. Wow.
Yeah, think about that. During a period where, some might have still felt that lingering chill from the crypto winter.
Sure.
And then on Friday, it hit the $4,000 mark, first time in 8 months. That's a big psychological barrier.
Definitely unlocks some momentum.
And it clearly did. The rally didn't stop there. It kept going, trading above $4,350 at one point on Monday. That's its highest level since back in 2021.
Okay, so near multi-year highs.
Exactly. Now, it has corrected a little bit back to around $4,186 as we're talking, but still it's operating at levels we haven't seen in years. It is worth noting, though, it's still about 14% down from its all-time high.
Which was around $4,878 back in November 21, right?
That's the one. But yeah, the current momentum is just undeniable. It's clearly a leader in this alt season.
So an 80% surge is incredible in any market. But for an asset the size of Ethereum, what exactly lit the fuse? Was there one specific catalyst analysts are pointing to for this sudden investor appetite?
There was actually a very clear one, and maybe surprisingly kind of a traditional finance-driven catalyst, according to the analysts.
Oh, interesting. What was it?
Investor appetite really picked up, they say, after stablecoin issuer Circle launched its blockbuster IPO on June 5th.
Ah, the Circle IPO. Okay. But why would that specifically boost Ethereum so much?
Well, think about what Circle does. Their main product is USDC, a massive stablecoin. And this IPO wasn't just, another tech company going public. It was a major financial player stepping onto the public stage.
Right.
And by its very existence, implicitly shouting to the world, hey, our multi-billion-dollar operation, the thing underpinning a huge chunk of the digital economy, it runs fundamentally on Ethereum.
Gotcha. So it wasn't just crypto natives who knew this already. The IPO made Ethereum's role really tangible and undeniable for, a mainstream financial audience.
Exactly. It's like if a major airline IPO'd and suddenly everyone realized their entire fleet runs on engines from this one specific, maybe previously niche manufacturer. It brings that background infrastructure right to the forefront.
It bridges the gap almost between the crypto world and traditional finance, making Ethereum's utility less abstract.
Precisely. The visibility of Circle's IPO drew institutional and mainstream attention to this critical, often unseen part of Ethereum's utility. For many in TradFi, stablecoins were just tools, right? Maybe the underlying tech seemed too complex or niche.
Just digits on a screen.
But when a high-profile IPO highlights that this massive, multi-billion-dollar stablecoin market is predominantly powered by Ethereum, that can fundamentally shift perception and capital flows.
It turns an abstract tech concept into something tied to a tangible, revenue-generating, publicly traded entity.
Exactly, directly linking Circle's value in part to Ethereum's proposition. That kind of event is a powerful signal. It draws in new capital from investors who might have previously seen crypto as just too speculative or disconnected from, real-world applications.
Making the intangible tangible confirms Ethereum's role in that whole stablecoin economy.
That's it, a foundational role, facilitating billions in value.
Okay, so we have this context. An emerging alt season, ETH surging impressively, and its fundamental infrastructure role getting highlighted by things like the Circle IPO. The natural next question is, what does this mean for specific companies tied into this ecosystem? Who stands out?
Right, who are the big winners here?
And that brings us straight to Section 2. Coinbase in the spotlight. Because according to Bernstein, if you're looking for that prime beneficiary, their answer seems pretty clear. It's Coinbase.
Yep, they're quite emphatic about that.
They're not just saying Coinbase will do well, they're calling it the biggest beneficiary of ETH's rise and this alt rally. That's a really strong claim in a competitive market. What's the core argument? Why Coinbase?
It's a really comprehensive argument, actually, and it boils down to Coinbase's let's call it strategic positioning within the whole Ethereum ecosystem. Bernstein firmly believes they benefit most because they see Coinbase as one of the leading Ethereum-aligned public companies.
Okay, Ethereum-aligned. What does that mean in practice?
They break down Coinbase's pole position, as they call it, into 3 distinct but kind of interconnected pillars.
Right, the 3 pillars, what are they?
Okay, so first, it's long tail of supported tokens. Second, substantial staked assets. And third, maybe the most interesting one, it's growing base chain revenue.
Long tail tokens, stake assets, base chain revenue. Okay.
And these aren't just buzzwords, right? They represent distinct, powerful revenue streams that are directly correlated with growth and activity on Ethereum and in the broader altcoin market.
So it gives them a unique advantage during this kind of market phase.
Exactly. They argue these 3 things together give Coinbase this powerful edge. They're not just an exchange. They've kind of woven themselves into the fabric of the ecosystem's infrastructure and its financial activity.
Okay, let's unpack those pillars then, one by one, because it really paints a picture. First, this long list of supported tokens. How does just listing a lot of assets, which sounds basic for an exchange, actually position them so well for an alt season?
Well, it's more strategic than it sounds, especially during an alt season. Why? Because market activity broadens out, right? It's not just Bitcoin and Ether trading. Capital flows into smaller, maybe more specialized altcoins.
The long tail.
Exactly. Coinbase lists over 250 different tokens. So when that broad market rally happens, having such a wide variety available means they capture a larger slice of the overall trading activity.
Right, people looking for that specific hot altcoin are more likely to find it there.
Precisely. And think about it, some of these smaller cap alts can see absolutely explosive growth during these periods. Coinbase is positioned to facilitate those high volume, high fee trades.
Okay, makes sense.
But what's particularly compelling now, and a crucial expansion of this long tail idea, is that Coinbase has also integrated the long tail of base chain tokens directly into the Coinbase app.
Base their own layer 2 solution on Ethereum.
Right. So by integrating those tokens seamlessly, they're directly capturing activity and interest within their own rapidly growing Ethereum-aligned ecosystem. It's like they built a popular neighborhood and also own the only convenience store there.
Gotcha. So it ensures that as capital flows into diverse alts, whether directly on Ethereum or through scaling solutions like Base, Coinbase is there to handle the trade and get the fee.
They're essentially casting this massive net, scooping up all this diverse investment flowing into alts, a one-stop shop for alt season trading.
Okay, capturing the breadth of the market. That's pillar one. Pillar two, substantial staked assets. This seems like a more direct play on ETH itself, right?
Yeah.
How does staking ETH contribute so significantly?
Oh, yeah, this one's really direct. Staking activity, particularly with ETH, accounts for a remarkable 10% of Coinbase's total revenue.
10%. Wow, that's not small.
Not at all. It's a crucial, high-margin revenue stream that benefits directly from Ethereum's proof-of-stake design. Holding and staking ETH earns rewards for securing the network.
Right.
Coinbase, as a major exchange and custodian, offers easy staking services, even for smaller investors who might not want to run their own validator node.
Okay, they make it accessible.
Exactly. And in return, Coinbase takes a cut of those staking rewards. So here's the kicker. As the price of ETH rises, not only does the value of the ETH being staked go up,
But the rewards themselves, paid in ETH, become worth more in dollar terms.
bingo, it's a powerful multiplier effect. And it doesn't stop there. Beyond that direct staking revenue, Coinbase also holds a very substantial ETH treasury themselves.
Oh yeah, how much?
About 136,782 ETH. At current prices, that's worth roughly $570 million.
$500 million in ETH on their balance sheet.
Yep. And this isn't just like a speculative side bet. It's a significant asset. So as ETH prices climb, the value of this treasury inflates directly. Big boost to their financial health, asset base overall valuation.
Creates a real flywheel effect then. Rising ETH boosts staking revenue and treasury value.
Exactly, reinforcing their position as a primary beneficiary of the whole Ethereum ecosystem's growth.
This really does highlight their multifaceted approach, not just an exchange. They've really embedded themselves. Okay, so the third pillar, base chain revenue. This sounds maybe the most forward-looking. What makes Base such a powerful play for them?
Yeah, base chain revenue is arguably one of the most, let's say, structurally significant advantages for Coinbase because it shifts them from just being a venue to being an infrastructure provider.
Okay, explain that.
Base, as we mentioned, is their own layer 2 network, built on Ethereum, designed for faster, cheaper transactions for dApps. And it's not just some small experiment. The numbers are already substantial.
Like what?
The base chain is handling over 9 million transactions daily.
9 million a day. That's huge volume.
It really is, across all sorts of applications built on it. And this translates directly into recurring revenue for Coinbase in a pretty unique way.
How? Through fees.
Yep. Gas fees on Base are settled in ETH, and Coinbase as the primary sequencer for Base.
Okay, the sequencer, that's like the traffic controller for the layer 2, ordering transactions.
Exactly. They order the transactions before they get bundled up and sent to the main Ethereum chain. And for being that sequencer, Coinbase collects roughly $75 million in sequencer fees annually.
$75 million a year just from ordering transactions on their own L2.
That's the estimate, yeah. They essentially built the highway, and now they're collecting tolls on a massive amount of traffic. It's a recurring revenue engine. And it's not just the sequencer fees. They also get brokerage fees from integrating base chain tokens onto their main exchange, like we talked about. Plus, they just launched the Base app for crypto transactions, making it even easier for users to get into that ecosystem.
So they're capturing value at multiple layers: transaction fees on Base, trading fees for Base tokens, user adoption through the app.
Exactly. It shows they're not just passively benefiting from volume. They're actively building the infrastructure, participating in its growth, and capturing value all along the way. It's a powerful long-term play, tying their future directly to Ethereum's scaling and adoption.
Okay, so given all these advantages, the token list, the staking, the Base chain revenue, it seems almost weird that Coinbase's shares actually plunged, what, over 15% after their Q2 earnings last month?
Yeah, that definitely raised some eyebrows.
The Bernstein analysts urged investors not to overreact. They actually said Q2 is the quarter that doesn't matter for Coinbase. How should someone interpret that? Is it just spin?
It raises a really important question, actually, that goes beyond just Coinbase. How much should these backward-looking quarterly reports dictate your view in a market that's moving this fast and recovering?
Right, especially in crypto.
Bernstein's point is basically that the real market recovery, the significant shift, started after the Q2 reporting period ended, mostly in July.
Okay, so the Q2 numbers reflected the older, slower period.
Exactly. They pointed out that Coinbase's trading volume in July was tracking something like 40% higher than the Q2 average. That's a huge jump.
40% higher just the month after Q2 ended.
Yeah. So traditional finance often gets hung up on those reported earnings looking backward. But in crypto, which is so cyclical and forward-looking, that backward glance can be really misleading about the current momentum and future potential.
So Bernstein is saying, don't focus on the rearview mirror when the road ahead just changed dramatically.
That's basically it. Adopt a forward-looking view. Market cycles don't always line up neatly with quarterly calendars.
That makes sense. Don't miss the forest for the trees, or the recent past for the emerging trend. So what are the concrete implications then for Q3 and Q4 earnings? What are analysts expecting now?
Well, the implications are pretty significant and generally positive based on this view. Bernstein explicitly expects Q3 and Q4 to be strong trading volume quarters for Coinbase.
Strong, okay.
And it's not just wishful thinking. It's driven by all the factors we've talked about: rising ETH, the alt rally, more investor participation, and importantly, increased activity across all those revenue streams. Trading, staking, Base.
The whole engine is firing up.
Right. And their prediction is that the surge in activity will basically force other analysts, sell-side consensus, to scramble to move up their estimates for Coinbase's future performance.
So expect upgrades.
That's the implication. It emphasizes that forward-looking view. The Q2 dip was maybe just a lag, reflecting a slower market that's now in the past. The real revenue potential is materializing now in the current and upcoming quarters.
So for investors, the message is, look beyond the last report. Focus on the current market dynamics and how Coinbase is positioned.
Yeah, understand that sometimes the market's initial reaction to old data can overlook fundamental shifts happening in real time, especially in a space evolving as fast as crypto.
Okay, that clarifies the Coinbase picture. But as you said, the Ethereum growth story isn't just about one company, even a big one like Coinbase. Who else is riding this wave? What are other players doing?
Good question. It's definitely broader than just Coinbase.
That brings us to Section 3. Beyond Coinbase. It seems Robinhood, a name many know for stocks, is also making pretty significant crypto moves.
Wow.
What are they up to?
Yeah, Robinhood is positioning itself as, maybe surprisingly for some, a pretty formidable player here, moving beyond just being the stock app.
Okay.
Bernstein expects Robinhood's crypto volumes to surge in Q3 as well, and it's driven by several pretty smart strategic moves they've made.
Such as?
Well, first, similar to Coinbase, they expanded their crypto offerings, now over 30 tokens. So again, capturing that broader alt season participation.
Right, appealing to the crypto crowd.
Exactly. More importantly, though, they've added Ethereum staking.
Ah, okay. So directly aligning with ETH's growth and getting that staking revenue stream.
Precisely. But maybe the most significant move, the one that signals a deeper commitment, is the launch of Robinhood Chain.
Robinhood Chain, what's that?
They describe it as a Layer 2 ecosystem, apparently built using Polygon's tech, focused on asset tokenization.
Wow, okay.
Yeah.
So Robinhood is building its own Layer 2, like Coinbase did with Base, focused on tokenizing assets.
Seems like it. It's a bold step. It means they're not just offering crypto trading, they're actively building infrastructure connected to the Ethereum ecosystem.
That's a big shift. aiming to facilitate faster, cheaper transactions for tokenized assets that could unlock totally new products for them.
Absolutely. It signals this broader institutional embrace of the underlying tech, its potential for new financial products. Shows a commitment to build within the space, not just participate from the outside.
Definitely a play to attract that younger, crypto-native user base and stay relevant.
For sure, a clear strategic move for their future.
Okay, so Robinhood is stepping up. And another big player, Circle, the stablecoin issuer. We mentioned their IPO briefly. Let's dive a bit deeper. Why is Circle so tied to Ethereum's success?
Circle's connection to Ethereum is, well, it's fundamental. It's symbiotic, really, because their main product, USDC, is almost entirely minted and primarily circulates within the Ethereum ecosystem.
Right, most USDC is on Ethereum.
Yeah, we're talking a massive amount of value here, underpinning a huge part of the global digital economy. Over 60% of all USDC is on the Ethereum base layer.
60%.
And another 10% or so is on Ethereum layer 2s, like Base and Arbitrum, which still rely on Ethereum security.
So 70% tied directly or indirectly to Ethereum's infrastructure.
At least. And what this means is, as Ethereum's network activity grows, as DeFi applications built on Ethereum expand,
The demand for USDC as the stable asset within that ecosystem just naturally goes up.
exactly. We saw USDC supply grow 7% in the last 3 months, reaching over $65 billion. That growth is fueled by Ethereum's expanding financial ecosystem. People need USDC for smart contracts, for lending, borrowing, trading on DXs as collateral.
It's the lubricant for the DeFi machine running on Ethereum.
That's a good way to put it. So connecting back to the bigger picture, Circle's deep reliance on Ethereum really underscores Ethereum's critical infrastructure role. It's not just facilitating ETH transactions, it's providing the secure, programmable rails for a massive global stablecoin.
Ethereum is the backbone, Circle leveraging it for digital commerce.
Right, so Circle's success is, in many ways, a direct testament to Ethereum's increasing utility and adoption as that foundational layer for digital finance.
Really reinforces that digital plumbing idea. Okay, so beyond these major platforms, Coinbase, Robinhood, Circle, what other ways are there for people, maybe more traditional investors, to get involved? Are new investment avenues opening up?
Yes, definitely. And this is where things get particularly interesting, especially bridging TradFi and crypto. Section 4 is all about these diverse investment avenues.
All right, and the big one everyone's talking about, spot Ethereum ETFs. We saw the Bitcoin ETFs launch. Now ETFs are approved, waiting to launch. What's particularly interesting here, especially with BlackRock's move?
The spot ETH ETFs themselves are a huge deal, obviously. They offer that regulated, familiar way for both institutional and retail folks to get ETH exposure directly, holding the actual crypto.
Lowers the barrier to entry massively, right? No wallets, no private keys.
Exactly. Huge pool of capital potentially unlocked. But the real game changer, the thing Bernstein highlighted, is BlackRock's proposal to add a staking feature to its iShares Ethereum trust ticker ETHA.
Staking within the ETF. How would that work?
It's incredibly significant. It means the ETF wouldn't just passively hold ETH, tracking the price. It could actively participate in the network's economics.
Okay.
By staking some of the ETH it holds, the ETF could generate an ETH-denominated yield. Analysts estimate around 2.9% annually.
From helping validate transactions, secure the network.
Right. It effectively incorporates blockchain economics into the ETF, as Bernstein put it.
So the ETF isn't just a passive holder anymore. It becomes an active participant, earning yield for investors. That feels new.
It really is a major leap forward. For ages, traditional investment vehicles could only offer passive crypto exposure, like holding a commodity.
Right, just price tracking.
But by adding staking, BlackRock is pushing the boundary. Investors could benefit not just from potential price appreciation, but also from the inherent yield generation of proof-of-stake Ethereum.
It's like investing in a company that not only grows, but also pays dividends.
Exactly. It integrates the fundamental utility and economic activity of the blockchain directly into a traditional investment product. It's not just mirroring the asset, it's tapping into its core function.
That must make it way more attractive to certain types of investors, right? Like institutions looking for yield.
You'd think so. Pension funds, endowments, wealth managers. They often look for income generation, not just pure speculation. This could be a much more complete way for them to embrace the asset's potential.
A sophisticated merging of the two worlds, making blockchain stuff accessible in a familiar package.
Speaks volumes about how the crypto investment landscape is maturing.
Absolutely fascinating. Okay, so that's ETFs with staking. Then Bernstein also highlighted a more actively managed approach, Ethereum treasury companies. They compared it to Michael Saylor and MicroStrategy with Bitcoin. How do these work?
Yeah, this raises that interesting question. What's the appetite for more active balance sheet-driven strategies, moving beyond just passive holding?
Right.
These Ethereum treasury companies basically take the MicroStrategy playbook and adapt it for ETH. They're usually public companies that actively acquire a lot of ETH, sometimes using modest leverage.
Okay, accumulate ETH, but they don't just sit on it.
No, that's the key difference. Their core strategy isn't just holding, it's actively managing the balance sheet risk, yes. But crucially, they deploy the ETH
Deploy it where?
into staking, like we discussed, but also into other on-chain finance activities. Think DeFi lending, providing liquidity, yield farming, that sort of thing, all to generate additional income on top of their core ETH holdings.
Okay, so they're not just betting on the price going up. They're trying to make the ETH itself productive within the ecosystem, generating extra yield. That sounds much more active.
Exactly. That's the fundamental difference from a passive ETF. These treasury companies adjust their strategies based on market cycles, sentiment, DeFi opportunities. It's active management.
More aggressive, potentially higher reward, but maybe higher risk too.
Potentially, yes. It offers a more engaged participation in the Ethereum economy for investors looking for that. But, and this is important, the analysts included a warning.
What's the catch?
Selecting the right manager for these companies is key. You need real expertise in both traditional finance and the fast-moving DeFi world to handle the risks involved. It's more complex than just buying and holding an EPF.
Makes sense. Requires a different skill set. Did Bernstein mention any specific firms doing this?
They didn't highlight specific names, no. But the concept itself shows this evolution in how institutional capital might engage, moving beyond speculation to active participation in network economics.
Okay, so we've covered Coinbase, Robinhood, Circle, ETFs, these treasury companies, lots of ways Ethereum's growth is manifesting and being invested in. Which brings us to Bernstein's overarching view, Section 5, the still early bull cycle perspective.
Right, the big picture take.
They recently argued it's still early in the crypto bull cycle. That's a pretty bold statement from a major firm. Given everything we've discussed, why are they so confident? What's the reasoning?
It's a really fascinating long-term view they're taking. It's not just seeing this as a market blip or a short rally. It really speaks to a belief in these fundamental shifts happening in financial infrastructure.
Okay.
And accelerating tech adoption that they think will just keep driving growth. Their still early assessment is basically rooted in the idea that all of these investment opportunities we just covered.
Coinbase, Robinhood, Circle, the ETFs, the treasury companies.
Exactly. All of them are incredibly well positioned to benefit from two big overarching trends.
Which are?
One, sustained rising trading and network volumes, just more activity overall. And two, significantly increasing mainstream adoption of digital assets.
Okay, so they see the infrastructure being built, the on-ramps getting smoother, and the utility becoming clearer.
Yeah.
Leading to more people and institutions coming in.
That's the core idea. The foundations are being laid, and the adoption curve is still relatively early.
What does mainstream adoption really look like in this context then, and how do things like those ETFs accelerate it?
Well, mainstream adoption probably looks like, more people and businesses comfortably using crypto for payments, investments, maybe even interacting with dApps without needing deep technical knowledge.
Less friction, more integration.
Yeah. And traditional finance integrating digital assets more naturally into their existing products, not just as some weird speculative add-on.
Right.
And the ETFs are a huge accelerant for the institutional side of that. They lower the barrier dramatically for large capital allocators, pension funds, endowments, wealth managers.
Groups that maybe hesitated before due to regulation or complexity.
Exactly. Now they have a familiar, regulated vehicle they understand and trust. This influx of institutional capital, combined with a growing retail base using platforms like Coinbase and Robinhood, creates this powerful network effect.
More users, more capital, more validation, more innovation.
Precisely. It validates the asset class globally, brings liquidity, fuels more development. The still early view suggests we're just starting to see the potential of this integration play out. Many more cycles of growth and adoption ahead as these pieces solidify.
So the current rally isn't just a moment, but part of this bigger, sustained trend towards digital assets becoming just part of the financial landscape.
That seems to be Bernstein's core thesis, yeah. A fundamental long-term shift that's still unfolding.
Okay, let's try and wrap this up then. Let's unpack this one last time. We covered a lot today.
We certainly did.
From really getting what alt season means, that market maturation signal, to seeing how players like Coinbase were leveraging their unique positions. Trading, staking, that base infrastructure. It's multifaceted.
Definitely not just a simple exchange anymore.
And we explored those new avenues opening up, like the staking ETFs that blend TradFi and crypto-native yield and those more active Ethereum treasury companies.
Yeah.
It's really clear the Ethereum ecosystem isn't just, buzzing. It's profoundly shaping the whole crypto landscape right now.
And redefining how traditional finance interacts with digital assets.
Yeah.
Absolutely. I mean, this deep dive into the Bernstein report really underscores Ethereum's foundational role in this whole market surge. It's the critical layer for stablecoins like USDC. It's a key revenue driver for exchanges through trading and staking. And it's the anchor for this new generation of investment products trying to bridge the old and new financial worlds.
It really ties it all together.
It does. And it raises, I think, an important question for all of us watching this space. As this crypto bull cycle potentially continues, and as more traditional financial structures adapt and find ways to integrate these blockchain economics, how is this interplay going to reshape things long-term? Not just digital assets themselves, but the broader financial landscape, banking, investing, global commerce. How different will it all look in the years and decades to come because of this integration?
That is definitely something to ponder. Food for thought as we wrap up.
Yeah.
A huge thank you for joining us on this deep dive today.